Are you ready to dive into one of the hottest stocks in the energy sector? Today, we're breaking down GE Vernova, ticker GEV, a powerhouse in the clean energy transition that surged over 225% in the past year. Is the stock still a buy, or is it running too hot? Stick around for a detailed analysis packed with the latest data as of August 28, 2025. Let's get started. Let's start with a quick overview. GE Vernova operates in three key segments: power, wind, and electrification. The power segment focuses on gas, nuclear, hydro, and steam technologies for reliable energy. The wind segment delivers onshore and offshore wind turbines, while electrification provides grid solutions, power conversion, and storage technologies. Founded in 2021 and headquartered in Cambridge, Massachusetts, GE Vernova employs over 76,800 people and is positioned to capitalize on the global push for clean energy and infrastructure modernization. Let's talk numbers. GE Vernova's financial performance in 2025 has been nothing short of impressive. In Q2 2025, the company reported revenue of $12.4 billion, a 12% increase year-over-year, driven by strong demand in its power and electrification segments. Earnings per share came in at $1.86, beating Wall Street expectations by 24%. Adjusted EBITDA grew 25% to $770 million, reflecting improved operational efficiency with an EBITDA margin of 5.3%. The company's cash balance stands at a robust $8 billion with no debt, giving it flexibility for strategic acquisitions and investments. Looking at the full-year outlook, GE Vernova raised its 2025 revenue guidance to $36 to $37 billion, up from $34 to $35 billion, with expected organic growth of 6 to 7% in the power segment and a whopping 20% in electrification. The wind segment, which has been a weaker performer, is projected to approach break-even in the second half of 2025. Free cash flow guidance was also boosted to $3 to $3.5 billion, signaling strong liquidity. Over the next few years, GE Vernova aims for $45 billion in revenue by 2028 with a 14% adjusted EBITDA margin, supported by $4 billion in capital expenditures and $5 billion in R&D investments through 2028. One standout metric is GE Vernova's massive $129 billion order backlog, which underscores its long-term growth potential. This backlog is fueled by surging global electricity demand, particularly from AI data centers, electric vehicles, and industrial electrification. The company's focus on grid modernization and clean energy aligns perfectly with global trends, including government incentives like the U.S. Inflation Reduction Act. However, it's not all smooth sailing. The company's net profit margin is relatively low at 4.41%, and its return on assets is negative at -17.57%, indicating challenges in generating profits from its asset base. Additionally, year-over-year profit growth was negative at -35.17%, which raises some concerns about short-term profitability. Now, let's zoom in on GE Vernova's stock performance. As of August 28, 2025, GEV is trading at approximately $622.39, down 3.52% in the past 24 hours, but up an astounding 225.36% over the last year. The stock hit an all-time high of $664.29 on August 6, 2025, and a low of $115 on March 27, 2024, showing significant volatility with a beta coefficient of 1.59 and weekly volatility of around 4 to 6%. Despite a recent 7.6% weekly decline, the stock has rallied 79% year-to-date, outperforming many peers in the industrial and energy sectors. But is GE Vernova overvalued at these levels? Let's break it down. The stock trades at a price-to-earnings ratio of 143x, far above the electrical industry average of 30x and its peer average of 26x. This suggests the market is pricing in high growth expectations. According to Simply Wall ST's discounted cash flow model, GE Vernova's intrinsic value is estimated at $647.57 per share, meaning it's trading about 6.4% below its fair value. However, compared to a proprietary fair ratio of 68.64x, the current PE multiple indicates potential overvaluation. Analysts are mixed but lean bullish. Out of 27 analysts, The consensus rating is buy with an average 12-month price target of $559.23, implying a 7.15% downside from current levels. Price targets range from $255 to $736, reflecting uncertainty. Some analysts, like those at BMO Capital and Morgan Stanley, remain optimistic, citing GE Vernova's strong fundamentals and growth prospects, while others, like Guggenheim, have downgraded it to neutral due to valuation concerns. Why has GE Vernova been such a standout? It's all about its position in the energy transition. The global push for decarbonization and electrification is driving demand for GE Vernova's products. AI data centers, which require massive amounts of reliable power, are a key growth driver. The company's $129 billion backlog includes orders for grid solutions and power equipment to support this demand. Additionally, government policies like the U.S. Inflation Reduction Act and similar programs globally are fueling investment in clean energy infrastructure. GE Vernova's strategic moves are also boosting its outlook. The company recently announced a $6 billion share repurchase program with no expiration date and a quarterly dividend of 25 cents per share, yielding 0.16%. While the dividend yield is modest, it signals confidence in future cash flows. GE Vernova is also investing heavily in innovation, acquiring France-based Altia to enhance AI-driven grid management and planning to add 250 jobs at its Pennsylvania Grid Solutions factory. Partnerships are another strength. GE Vernova is supplying hydrogen-enabled gas turbines for a 4.5 gigawatts data center campus in Pennsylvania and collaborating with Duke Energy on natural gas turbines to meet rising energy needs. These deals highlight its role in both traditional and renewable energy markets. No stock is without risks, and GE Vernova is no exception. First, its high PE ratio suggests the market expects significant growth, which could lead to a correction if expectations aren't met. Project execution risks are a concern, as large-scale power and grid projects often face cost overruns or delays. Supply chain disruptions could also impact timelines and costs, especially in the competitive renewable energy sector. Policy uncertainty is another factor. Changes in government incentives or regulations could reduce demand for clean energy solutions. Interest rate sensitivity is also a risk, as higher rates increase the cost of capital-intensive projects. Finally, there's an ongoing securities fraud investigation by firms like Levi and Korsinski, which could create negative sentiment, though no concrete findings have been reported as of August 2025. Let's wrap this up. Should you buy GE Vernova? Here's the bull case. GE Vernova is a leader in the energy transition, with a $129 billion backlog, strong Q2 performance, and exposure to high-growth sectors like AI and electrification. Its $8 billion cash reserve, no debt, and strategic investments in AI and grid technology make it a compelling long-term play. Technical indicators also suggest bullish momentum if support holds. On the bear side, the stock's high PE ratio and recent volatility raise concerns about overvaluation, weak profit margins, negative return on assets, and risks like project execution and policy changes could weigh on performance. The ongoing securities fraud investigation is another wildcard. That's it for our deep dive into GE Vernova. What do you think? Is GV a buy, hold, or sell? Drop your thoughts in the comments below, and let's keep the conversation going. Thanks for watching, and I'll see you in the next one.